Hello, this is two-part presentation, and the first part is on financial statement and ratio analysis. These are the learning goals that we are going to cover. First, we are going to look at the review of the contents of the stockholders reports and the procedure for consolidating international financial statements. Few of the rules and regulations we are going to look at in this learning goal. Next, we will move to the second learning goal, which is to understand who uses financial ratios and how. And finally, we're going to work through first few of the ratios to analyze a firm's liquidity and activity. So what is a stockholders report? The parts of the stockholder reports will be discussed later. But under what regulations these stockholder reports are structured? In US, these are called generally accepted accounting principle. GAAPs are the practice and procedure guidelines used to prepare and maintain financial records and reports authorized by financial accounting standard boards. When it comes to international standards, we have International Financial Reporting Standard, IFRS. International financial reporting standards are established by the International Accounting Standard Boards, and more than 80 countries now require listed firms to comply with IFRS, and dozens more permit or require firms to follow IFRS to some degree. Now, these rules and regulation guides how to construct and develop financial statements. However, there is always a room for maneuvering. Here comes the concept of ethics. Why might financial managers be tempted to manage earnings? Now, manage earnings means that financial managers tempt to show higher earnings or low earnings for certain reasons. The second question is it unethical for managers to manage earnings if they disclose their activities to investors? Now, I would want you to think over it, and by the end of the second presentation, we'll have a more clear pictures to answer these questions. As we discussed, we have four key financial statements. The first in the series is income statement. As you already know, perhaps, that the income statement provides a financial summary of a company's operating results during a specified period. Now, this has to be a specified period. Although they are prepared quarterly for reporting purposes, they are generally computed monthly by management and quarterly for tax purposes. Since we are following US system, you can see this in the US context. Let's look at the company income statement. First, it's given as in millions, thousands. So the figures are smaller here, but you have to add these zeros to these figures here. And you can see we all start with for the years ended. For the years ended December 31. So this must be mentioned that from one year to another, how much activity happens. Sales. The income statement always starts with sales revenue, then it has a cost of goods sold. We calculate, subtract it, and we get gross profit. Then we combine all the operating expenses. And operating expenses are all these which includes selling expense, general and administrative expense, lease expense, depreciation expense, and then we have a total operating expense here. Then we have operating profits. So gross profits minus operating profit becomes operating. Gross profits minus operating expense becomes operating profits. Then we less or subtract interest expense, and then taxes. So net profit before taxes does not have interest, and net profit after taxes removes or subtracts almost everything. Finally, we are left with dividends, preferred stock dividend, and what is available is called earnings available for common stockholders. These are the residual earnings, and the common stockholders always get what is left after paying for everything and everyone. At the end of the final statements, you will always see the earning per share, dividend per share figures. Also, you can see these notes. These are very important notes that you have to see, that what is lease expense. Here is mentioned lease expense, or certain calculations shown here, how they calculate the number of shares outstanding. So you have to familiarize yourself with the income statements, and then whatever we do, we see the change from one year to another year, how these changes happens, and we will come to these techniques of analysis in a few moments. The second statement in the series is balance sheet. The balance sheet provides a summary of firm's financial position at a given point of time. So it does not take the entire year, rather one point of time in the year, such as what is the financial position of a firm at on 31st December. So it will be on that day, and the summary will show the financial position of a company on that 31st December, the one day. If you look at this statement, you can see it's 31st December. It's not written for the period ended, rather it's just on that specific day. Now its assets are the first part, so we'll see the liabilities and owner's equity in the second slide. It's again for each year is given here. For the last 2 years or 3 years are given, so as the so that we can analyze the changes. Assets starts with the liquid assets first, and you can see that the cash, marketable securities, account receivable, and inventories, they all belong to total current assets, and these are $1.223 million in 2015. The fixed assets are given next, and you can see these are the fixed assets, and after that you can have the depreciation, accumulated depreciation, and total net fixed assets. The total fixed assets are the current assets plus the so this is current assets plus the total net fixed assets. You will get the total assets of the balance sheet. The liability and owner's equity part are given as follows, and you can see that the liability is begins with liquid liabilities. So these are called current liabilities. Accounts payable, notes payable, and accruals, these are claims, and as a company we have to pay back this money. Now these are the liquid liabilities, or what we call current liabilities. We have to pay back these money in a short run, while in long-term debt is given separately, which includes the financial leases as well. So these are the, when we add current plus the total liabilities, we get the current plus long term, we get the total liabilities, which is $1.643 million. After that, there is equity section, and this equity section is important to understand. We have preferred stocks, we have common stocks, we have paid in capital in excess of par on common stocks, and retained earnings. That all comes down to total stockholders equity. Now preferred stocks, written cumulative 5%, $100 par 2,000 shares authorized and issues. Now this 5% is the dividend rate. It's $100 par with the 2,000 issues, and so preferred stock comes before common stocks, or in fact it's positioned before common stocks because they have a claim, and the claim is shown higher in a rank because of this 5% dividend. This has to be paid before any profit is distributed to common stockholders. Now common stockholders written $2.5 par, 100,000 shares, authorized shares issued and outstanding in 2015. 76,262 further issued. In 2014 it was 76,244. So certain shares were further issued, and the total number is reflected here, 191, and in 2000 14 it was 190. We'll come to look at how these have been further calculated. Paid in capital in excess of par on common stocks. So once the cost stocks were sold, the stocks were bought at a premium. So the market paid higher than what it higher than the higher than what the firm demanded. So the excess is being documented here as paid in capital in excess of par on common stock. Then we have retained earnings. The company operates over the number of years, and they have profits, and some profits are distributed. The rest of the profits goes back to the company. So these are the profit after tax, and profit after tax goes into two parts. The first is dividend to common stockholders, and the other is the retained earnings. And the retained earnings comes here in this account, gets updated as the retained earnings are increased. The total liabilities plus total stockholders equity equals the total liabilities and stockholders equity. Now, next in the series is retained earnings. The statement of retained earnings reconciles the net income earned during a given year and any cash dividends paid with the change in retained earning between the start and the end of the year. It's a pretty simple statement, and you can see that retained earnings balance given as this 1 million plus net profit after tax. For 2015 it was 231 million. So what dividends have been given as cash to preferred stock, common stock dividends subtracted, and what we have total dividends paid at 108, and the balance is now retained earning balance is 1135. So it increased by a certain amount after paying the dividends. The last statement that we have to study is cash flow statement. The cash flow statement is perhaps the most important statement in financial system. The financial statement, the statement of cash flows provide a summary of firms' operating, investment, and financing cash flows and reconciles them with changes in its cash. That's most important, the word cash and marketable securities during the period. So marketable securities is the closest cousin of cash. Let's look at the cash flows statement. So it is divided into three parts. You can see cash flow from operating activities, from investment activities, and from financing activities. Operating activities are normally comes from the changes in the balance sheet items, especially the current assets as well as current liabilities. Also, it is possible. The next is cash flow from investment activities, and investment activities you can see that increase in gross fixed assets and change in equity investment in other firms. So it's normally comes from long-term assets and long-term equity from balance sheet. Then comes from financing, where we have some current liabilities, long-term debts, and equity that are part of it. And we'll study this later in the next chapter, how the cash flow statement is constructed. So the balance here is cash provided by financing activities. This cash net increase in cash and marketable securities is 92. This is the figure that reconciles with the balance sheet beginning cash, and we'll look into this, how this is structured. Now, there is an important challenge of how to consolidate international financial statements. So if parent company is in US and the subsidiaries are in the other countries, so Financial Accounting Standards Board's 52 actually mandates that US-based companies translate their foreign currency denominated assets and liabilities into dollars for consolidation with the parent company's financial statements. This is done by using the current rate method. The current rates is simply a technique used by US-based companies to translate their foreign currency denominated assets and liabilities into dollars for consolidation with the parent company's financial statements. using the end year or current exchange rate. Income statement are normally also treated similarly. As far as equity accounts are concerned, they are translated in dollars by using the exchange rate that prevailed when the parent's equity investment was made. So basically, it is historical rate, and historical rate is the rate persistent at that time when the equity was issued. As far as retained earnings are concerned, they are adjusted to reflect each year's operating profit or losses, and then um, so let's move to the uh, interested parties who want to know about um, financial ratios and why they want to know about financial ratios. Ratio analysis involves methods of calculating and interpreting financial ratios to analyze and monitor the firm's performance. So the interested parties could be current and prospective shareholders. They are interested in firm's current and future level of risk return, which directly affects share price. Then there are creditors who are interested in the short-term liquidity of the company and its ability to make interest and principal payments. Then there is management is concerned with all aspects of the firm's financial situation, and it attempts to produce financial ratios that will be considered favorable by both owners and creditors. So this uh, analysis uh, is done using three important ways. The first is cross-sectional analysis, then the benchmarking, comparison, but cross-sectional and time series analysis are the most known, and they provide the best way to have a complete picture of a firm financial situation. The cross-section analysis is the comparison of different firms' financial ratios at the same point in time. So it's important that we know that it's the same point in time, involves comparing the firm's ratios to those of other firms in its industry or to industry averages. What is then benchmarking? Benchmarking is a type of cross-sectional analysis in which firms' ratios values are compared to those of a key competitor or a group of competitors that it wishes to emulate. Finally, comparison to industry average is also popular. Let's see some of the example. For instance, XYZ calculated inventory turnover for 2015 and average inventory turnover were as follows. So we have XYZ has a 14.8 while industry average has 9.7. Now this is important to understand that is it enough to have this this ratio, and it gives us a complete picture? I'm not sure so much, because inventory turnover is but one ratio and it's static in one point of time. So it gives us a very narrow window for analysis. Now XYZ appears to be doing very well and better than the industry average. The higher inventory turnover means that XYZ does not have inventory on their in their firm, and they quickly turn it into products and sell it. The faster the rate, the better. Now, if we look at the bigger table with many different industries, like this is computers, this is building materials, this is grocery stores, and these are merchandise stores, we see that, and a number of different ratios, we see that there is quite of a diversion. So in inventory turnover only, you can see that 14.8 was not 14.8 was not a better ratio as we saw for XYZ, because there are much better inventory turnover ratios available here. And so it depends on which industry it belongs to. We have to watch for that. So you cannot, we should not be comparing a company to the entire market. Rather, it would give us much better insights if we go to a close group of industrial firms in firms within that industry, and that will give us much better idea. Secondly, we have to see the different ratios. What's going on in current ratio, quick ratio, average collection period, total asset turnover, debt ratio. Then we have net profit margin, return on asset, return on common equity. How does it performing? It may be performing better in one ratio and may not be on two or three ratios, but an overall performance of the firm may not be better than the industrial counterparts. So it's appropriate, it's always advisable that we should look at all the ratios and make relevant comparisons. The second important, as I said earlier on, one of the challenge is that the turnover ratio was in 2015, so it was 14.8. 14.8 in 2015 is a single figure at a single point of time. However, if we know that figure 14.8 increases to 16 or it falls to 17 in 2016, it will give us a much better idea that how the firm is performing over the number of years. Time series analysis is exactly for this purpose. It is the evaluation of the firm's financial performance over time using financial ratio analysis. Comparison of it actually compared the current to past performance using ratios and enables the analyst to assess the firm's progress. Developing trends can be seen by using multi-year comparisons. The most informative approach obviously is a combination of cross-sectional and time series analysis. Here is one snapshot of one ratio with both cross-sectional and time series analysis. So we have average collection period. So it is basically the account receivable collection, and we see that Bartlett is the company and the industry averages are given here, and we can see that in 2012 industry was performing better than Bartlett, but in 2013 Bartlett is performing better than the industry, and the crossover where Bartlett outperformed the industry came here somewhere at the middle of 2012 and 13, and after that we see that there is a rising trend. Although the industry is also rising, but at a slower pace than the Bartletts. Now, one could simply say that Bartlett is doing wonderful in collecting accounts receivable. After all, if accounts receivable are collected faster, the cash comes to the company, and cash is what firms actually wants. It can invest it into and pay off its expenses, or it can do a lot of things with the cash. However, there is important challenges in this. We don't want a lot of difference between these two lines either. The reason is, if Bartlett stays closer to industry, it will have a lower average collection period. A higher average collection period means that the firm is offering a firm have a strict or more tight recovery system, which means they can lose a lot of customer. They can lose a lot of potential customers. And if they come close, the difference becomes shorter or smaller. What will happen that they will have more potential customer, which means higher sales. So one has to understand that deviating farther from the industry or keeping close to the industry have its own benefits and advantages and disadvantages. So what you have to look in the ratio analysis, and it has to be a bit of a caution. Ratios that reveal large deviations from norm merely indicate the possibility of a problem. A single ratio does not generally provide sufficient information from which to judge the overall performance of the firms, and that's what we have already gone through. Also, we have to see that the ratio being compared should be calculated using financial statements dated at the same point in time during the year. They have to be audited financial statement, and also the financial data has to come from the same source, or in the same way it has to be structured. Finally, we should know that there are economic variables that can distort the results. For instance, interest rates or exchange rates. We have to adjust the financial statement for those distortions in order to get the fair picture of the analysis. Let's start working on the ratios, liquidity ratios. The first in line is current ratio, which measures the ability of the firm to meet its short-term obligations. How do we calculate it? We calculate it by dividing current assets by current liabilities. So for the balance sheet, income statement, retained earnings, cash flow statements that were shown earlier, if we pick up the figures and we start calculating these ratios, it will be sorry for my writing. If you divide it, it will be with the liabilities, which is 620,000, comes out to be 1.97. Now 1.7997 has to be interpreted. So for every dollar of liability, we have approximately $2 of assets available. Now that's a very strong uh, position or liquidity position for a firm to be in. What if it's equal to 1, which means for every liability, we have $1 of assets, which means it's the minimum that you would want. And beyond that, if it's zero point 0.8 assets for every dollar of liability, then we are in a weaker position. So you have to interpret the ratios in the context. And uh, I would suggest that you always change the number in the denominator and see how, and keep the numerator constant and see how the ratio changes, and it will give you an insight into whether the ratio improves or distorts the results. The second is the quick ratio. It's also called acid test ratio, which includes inventory, which is generally the least liquid current assets. Now, it also gives us a more improved liquidity position of the firm. So quick ratio equals current assets minus inventory divided by current liabilities. So let's calculate for XYZ company. It is 1223 minus 289, and that gives us 620,000, and we get the results of 1.51. Now this is more restrictive ratio. So for every dollar of current liabilities, we have actually $1.5 available, and this gives us more stronger more stronger result, because now inventory is gone and what is left is the most liquid closer to the cash, and hence we are able to pay we should be able to pay our current liabilities fairly easily. Let's look at the challenge, and I would want you to go back and test this. You have Dell, Home Depot, and Lowe's, three companies. Current ratio and quick ratios are given, and the challenge is that all three firms have current ratios of 1.3. However, the quick ratios for Home Depot and Lowe's are dramatically lower than their current ratios. But for Dell, the two ratios are nearly the same. Why? I want you to go and look at the inventory ratios from the table and see why Dell has a little difference between its current ratio and quick ratio, while the others have higher. One possible explanation is obviously they have higher turnover ratio, higher inventory turnover ratio for Dell. So it's higher inventory turnover ratio. Now, higher inventory turnover ratio means that little inventory is left in their current assets, hence their ratio have little difference. While Home Depot and Lowe's have less inventory turnover, which means more inventory stays in the company. Hence, when you subtract it, their current ratio falls. But I would want you to go and look into it again. Next comes to the activity ratio. Activity ratio measures the the turnover. of inventory. So inventory turnover is basically cost of goods sold divided by inventory. And if we go to the XYZ company, it will be around 2088, so 2 point, it's around 2.2 million, around 2 million, um, 2 million divided by 289, that gives us 7.2, which means for every dollar of inventory we are able to convert for every dollar of inventory we can convert 7 times to cost of goods sold. Now this is the higher the turnover, the better. Next, we look at the average age of inventory. Is the average number of days sales in inventory. So we divide 365 by inventory turnover and we get average age of inventory. In this case, we have 365 divided by 7.2, which we got from the last slide, and this goes 50.7 days. Now 50.7 days, um, uh, it takes 50.7 days, or average number of days sales in inventory. The next is the average collection period, which is the average amount of time needed to collect accounts receivable. So it's basically accounts receivable divided by the average sales per day. Account receivable divided by annual sales divided by 365. And if we do it for the company, we can see that it is equals to and that comes out to be 59.7 days. We have to compare the average collection with the average um, uh, uh, payment period to see which one is higher or lower. Now, average payment period, how do we calculate the average payment period? Average payment period is calculated by dividing accounts payable divided by average purchases per day, and then accounts payable divided by average annual purchases divided by 365 to average it. So this is basically, we do it for averaging. And now if you use it for XYZ company, we have 382,000 divided by, we have purchases 0.7 into 2088, 2 million, and if we divide by 365 we get 95.4 days. So we are paying in 95 days while we are collecting in 59 days. So it's always good to have this idea that payments should be extended as much as possible, because the cash is invested back into the company and it's also reduces reliance on the external cash. And collection has to be as early as possible. It also reduces default, it also increases the cash inflow, and the cash could be used. So from receivable, we are from collection period we are getting cash in lower in fewer days, while in payment we are paying in many days. So the difference gives us a larger amount of cash to be invested in the cycle, in the company's operational cycle. Then we have total asset turnover, which indicates the efficiency with which the firm uses its assets to generate sales. So it's basically sales divided by total assets, and in this case we have around 3 million. um, and if you divide it by 3 million, which is the total assets, 597, we get actually 0.85, and this 0.85 says for every dollar of assets how much sales we are generating. It's less than 1, which means we are not fully op optimally utilizing our assets. If it's greater than 1, obviously we are using our assets to create higher sales.